In this latest roundtable event in association with Watson Farley and Williams, we will discuss why the market might be seeing a rising demand for second charge bridging finance and the benefits such an option can offer borrowers. We will also look at whether first charge lenders are more comfortable with working with second charge bridging providers and what impact growth in this part of the market could have on the wider bridging sector. Richard Deacon, Sales Director at Marshaven Bank, will be joined by Ranjiv Kumar, Partner at Watson Farley and Williams. Also in attendance is Chris Corns, Operations Director at Crystal Specialist Finance, Andrew Robinson, CEO at Ark & Co, William P.W. Omini, Property Tax Advisor at Proactive Consult, and Sean Church, Director at Private Finance.
I think we're seeing more brokers wanting it as more brokers are getting into bridging. Okay. Obviously, they're looking for solutions for their clients where they can. So the more brokers that do bridging, the more then obviously look at doing seconds. I don't know whether there are more lenders doing it. There are a few lenders that are there and will do it as a second charge if they're doing a first already. Okay. But I don't think there are that many out there that will do just a standalone second.
I think there's certainly more unregulated lenders coming into the market who look at the second charge as almost a way in, as almost a route to entry, because it's not underserved. I mean, we've always done it at Marshaven for forever. It kind of makes sense to. But it's a case of they can come in, they see that there's a possible angle in with the risk element, so maybe the loan to value, which is, you know, slight question mark over that, but also the pricing as well, because the pricing isn't as competitive and as low as the first charge side of things as well. So if you're a new lender coming to the market, the second charge route to entry to that market is quite a good one.
What we're seeing from lenders that do the first and second now is less of the blended rates and more of them offering the whole charge on the first charge interest rate, whereas before, because the second's more expensive than the first, it used to be you can have X amount at this and Y at that, whereas now it's all at the first charge rate. So it's certainly making it more appealing.
They are indeed offering quite competitive rates, but they are still not encouraging it, as in actively going out and saying, hey, look, come to us for, second charges. But in comparison to normal fast charge bridging lending, it's like less than 10% of the total service that they're actually providing. So it is still a market that is out there to actually grow.
Are you finding that more lenders are also, first charge lenders are more comfortable working with second charge bridging lenders?
I think on the regulated side of things, they're pretty receptive to it. I haven't found too many of ours being rejected by the first charge lender at all. As long as the loan's been in place for 6 months or more, typically, they're pretty comfortable with accepting second charges against the sort of standard residential regulated mortgage. I don't know if you're finding anything different, Richard, at your side of things, but I haven't had too much pushback.
I think there's generally only one lender who doesn't allow the second charge, and I think we all know who they are, and I think that's more historical than anything else. But if you look at it from the first charge lender's point of view, you've got a bridge in there, generally speaking, for 12 months. So the risk element of having that second charge behind you really is negligible compared to a 20 or 25-year mortgage that they've got in place.
Yeah, I think some lenders, if you look on a development side from there, some lenders, well, a lot of the lenders now have got pre-agreed intercreditor deeds. So they're already working with the second charges anyway. So it's sometimes better, obviously, from our side if we're broking it. But if the senior lender has reduced their first charge exposure, they're naturally bringing in the second charge anyway. So they're near enough blending it in-house. So it is becoming more.
We find that on the transactions that we're instructing on, that the senior lender has a preferred partner in some cases to bring in the second charge, and also that the intercreditor principles are what they are, but most often the second charge holder would have a fully subordinated position.
So there's a lot of communication between second charge and broker. Because it's always about the exit. So if you're looking at 12 months on any kind of bridge, communication is where you're at in the takeout process. So if it's a development exit where they are in the sales period, if it's in a refurbishment or an equity release for some reason, where they are in their plan, and it's really important as a broker to communicate that to the second charge lender, just to keep the confidence and that everyone's happy.
we're actually seeing it more on the side of landlords and people who are looking at building up their portfolio, especially where there's a significant amount of equity. Most of them anyway come when they're already informed of what's going on and what they intend to achieve, in which case bringing in a second charge with loads of equity is very attractive to many lenders. So they'll end up saying, hey, look, all right, this is somebody who already knows what they're doing, and they know the strategy that they are trying to actually engage in. The risk becomes really, really low. It becomes a no-brainer.
You've got to look at the funding structures into bridging companies. So if you look at how the bridging market has changed over the last kind of 10 years, it's a lot more professional and a lot more institutionally funded. And what's happened is the covenants that these institutions are putting on the bridge lenders are becoming tighter. So when you're seeing economic impacts or valuations come down a bit, they're naturally getting more conservative as a first charge basis. So then you're seeing the second charge, rise in demand for that to get the leverage.
If you think mortgages can take, you guys be better with me with mortgages, but quite some time. Whereas bridging finance can be done and dusted within, typically 7 to 10 days. I know you had one recently, Chris, I think 3 working days, which is ridiculously quick, but it can happen. I hasten to add that probably wasn't a second charge.
No.
It's quick, whatever you're talking about.
Well, exactly. But I think surety of decision, speed, and as I say, when the exit route is something that will happen in the future, that's within 12 months or 18 months or whatever, however long it may be. I think that's what you want that's what the borough wants. They don't want the bridge; they need the bridge for that reason.
You said obviously the first charge in 3 days is pretty quick, but for a second charge bridging loan, what's the kind of average?
The only real difference is the consent. It depends on getting that piece in. If that lands quickly, then they can be a couple of weeks to get from start to finish.
How can a broker help as well speed up that process to get the consent?
And be proactive with it, definitely. Chase the first charge lender, make sure the documentation's correct on day one, any fees are paid correctly, the forms are filled in correctly. Some lenders will take 5 days to read a document, then respond. They need an amendment, it's another 5 days. It all just delays the process.
If you look at the conversion market, so maybe somebody has a commercial property they're buying on the cheap. Then at the end of it all, the exit is a massive, probably 50 to 60%, value appreciation. Even if you give the person, say, maybe a 70% or a 65% at maybe 1%, per annum interest, per month interest, the person is going to be happy to say, hey, look, I'll take it for 12 months because I know for sure I'm going to be making, a lot of value out of it. That will make sense.
We're seeing a rise in refurbs just to make a property marketable. So
right, okay.
Not necessarily adding value to the property, but just to make it desirable to a new purchaser.
What asset types in general are you finding that you're struggling to place cases which needs a second charge bridging loan?
Large single assets, central London. So again, that's looking at the economic factors and political that's going on. But that's everyone, the senior lenders and there, if you take out the residential regulated market and look at more the international and the private banks, they're restricting themselves to 50 or 60%. Now, we're not talking about shooting the lights out 90% on a trophy property, but even a 10% to push to 70 or maybe 75 in the prime area. It's a big market which is missing.